So before we start the risk warning, remember that spread betting and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 78% of retail investor accounts lose money when trading these products with this provider. You should consider whether you understand how these products work and whether you can afford to take the high risk of losing your money. Intraday is a trading name of Intraday Limited, which is owned and controlled by GVC Holdings plc. Intraday Limited is authorised and regulated by the Gibraltar Financial Services Commission and registered with the Financial Conduct Authority in the UK. Reference 597312. Registered address Suite 6, Atlantic Suite, Europort Avenue, Gibraltar. So, the markets. So, as I said before, it's all about really for me at the minute, kind of picking and choosing your battles. Some markets are responding well to the fundamentals, some aren't. I want to say, well, we're market neutral. I don't really care if things go up or they go down. The idea of making money in the markets is no longer about buying the low, selling the high, and vice versa, trying to be right on direction. It's about getting involved in the meat of the move. So prime examples, seeing, kind of these two big, candles here, absolutely. When you break that down into the 15-minute or 5-minute, you get a small amount of retracement and continuation down to overall hourly fibs. But if you break that down to the 5 and 15-minute chart, then maybe you've got, 6 or 7 opportunities where you could sell into that weakness, or even 1 or 2 opportunities to buy a significant bounce. And that all comes back to that idea of, trying to understand what the market has done and then what it can do. And that's a great tool for Fibonacci, because there's not a lot of tools out there that help you actually predict the future. Because when you look at the charts right now, what you're trying to predict is this black space here. Yeah, because that's the future. That's where the money is. But so many times people fall back into the habit of trying to go through too many styles of technical analysis, kind of too much information overload, and you end up contradicting yourself. So, people look at Ichimoku clouds, Elliott wave, Heikin-Ashi candles, and all of a sudden, if the exact setup doesn't present itself, you can't trade. And that's the whole point about just trading one product like the DAX. If the DAX is having a slow day and you see a small range, well, actually, the opportunity to make money from that is relatively small. So if you're looking for products to trade, then these are the 8 that I always look at. It hasn't changed since webinar day 1 all those years back. We have the DAX, we have the gold, we have S&P, the euro, dollar. We've changed that recently to the Nasdaq, so that has changed. That used to be the Swiss. Then we've got the FTSE as always, cable, and the dollar yen. So really, that gives me a snapshot of the world's thinking. If something happens out there, all or some of these products will move. So when you see things like this, obviously, don't need to kind of go through the news. That's Brexit. Okay, so that's the pound shooting up against the dollar, because the dollar's relatively high too. So it has to be something news to do with the status quo of Brexit. So gold coming down, that's an indication of safe haven. So again, people are looking to be more risk on, so they sell gold, because gold is, obviously somewhere you put your money when things are risky. Now, risk, as we all know, that's very subjective right now. So if you see gold coming down, you expect the stocks to be the high. So yes, they are. Stocks are towards the high. So that means the world as we know it is kind of working the way it should. So this doesn't marry up. So there has to be some give in this. The dollar has to go up or the pound has to go down. That can't continue like that. And obviously, when you look at the stocks, DAX is relatively high towards the intraday highs. So is the S&P. FTSE's not. Now the FTSE's gone down because the pound's got more expensive. So it's become dearer to buy FTSE. But as I say, all these things, this kind of triangle here are all correlated. They all follow the S&P. So as the stocks are high, stocks are high, stocks are high, the FTSE at some point will have to get a bounce. So again, it's something else to play into your kind of toolbox. It doesn't mean that you have to buy it right now, but that does look relatively low in the range. So that just could be an idea to buy some spikes if the stocks go higher or remain where they are. So an easy way of identifying a product to trade just by looking at correlated markets. So it's quite a simple, kind of strategy, really. If you understand, that stocks are risky and gold's safe and currencies move, in baskets. So, when the euro dollar is going up, the dollar yen should be going down, again, based upon this idea of you understand why the world and why things are moving. So another way of looking at the world is by interest rates. So again, very interesting to see how Donald Trump has played things with the Fed. and how he wanted these big cuts, and they didn't necessarily come yet, but doesn't mean they're not going to come. So that just means, as the dollar has been selling off, basically on the world, thinking Donald can do what he wants. You see this kind of rejection, the market move higher, rejection move higher, and the markets are creeping back up, and again that lovely kind of movement through the fibs to lower support, back to the fibs and support, and then right back to that 50%. Now you have to remember about the dollar is that it's the world currency, so it doesn't really matter how bad things get, for the kind of interest rate scenario, or for growth, or for Donald Trump, or impeachment, all that kind of stuff. There isn't that much place to put the trillions of dollars that exist in the world. Now, $1 trillion is traded on the FX markets every day. So you have to think that it doesn't really kind of matter how bad the situation gets in America. You can never get rid of the dollar because, for a start, commodities are priced in dollars. Yeah, it's the world currency. So there's always going to be that demand for the dollar. So that's another way of looking at what's happening in the other currencies to see where is the demand going down, and where that demand goes down, it goes back and flows back into that dollar. So again, another way of just pitting out what you think in the world and picking the kind of product and correlation. And it's not necessarily, as I say, that you just get long the dollar now because the euro is coming down. You think that dollar's going to strengthen. It's about going to these individual time views. And, this is something I've shown you a number of times now. So, just typical, isn't it? The one I want I've actually changed. So if we go to the euro dollar, for instance, we think that's going to come down. Well, then we have our daily view, we have our hourly view, our 15-minute view, and our 5-minute view. So what we can see is that the consolidation below the 50% on the hourly chart, and we've seen a big signal here. The market is overbought, so we're getting ready for that. So what we can do is we can see on the 15-minute chart, then you can just sell every red line and buy it back. Yeah, sell every. I mean, this candle closes green, but it goes down all the way here. So when you look at this 15-minute, kind of instance of really what is just these red hourly candles, because remember, every 4 50-minute closes gives you an hourly signal. Then when you look at the the kind of idea, you've really got a range of about 100 pips. So again, you can sell it for 20, 30 pips, get out. Sell it for 20, 30 pips, get out. Your 50% is that bounce point, and if it continues a little bit further down, then you've obviously got your Fibonacci's, where the green lines become your points of exit, your points of attraction. And I'm not saying that you buy into the dips as well, because that can be a bit greedy. But as long as you just sell all the high points, every 15 minutes that market, is spitting out, 10, 15, 20 pips. So yeah, all very well. In the whole kind of scenario, you can sell here, excuse me, and buy it back here. But as I've said, so many people go into that mini investing mentality, and all you're doing is making, your 100 pips, but you're leaving all that money on the table, because every time that candle comes back, yeah, you might get stopped out, or if you're keeping a longer term position, you just see money here in your P&L, no money, money in your P&L, no money, lots of money in your P&L, no money, minus money, money in your P&L, no money, 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 money. Finally, you get out here, but all those opportunities, when you've gone back up to the higher parts of the range, you've actually given money back to the market because you haven't got out and then got back in. So that, again, is the whole idea I've been trying to drill through to people, that it's not about being right. Because, yeah, you are right. If you sell the market here and you let it go all the way down here, you've held the market for 6-7 hours, and yes, you've made 100 pips. However, two things have happened. Opportunity cost. You've only done one trade. So yes, you've made money, but all that opportunity cost in all the other markets might have been tied up by your capital, by your attention. Just by focusing on one product, you've lost out on all the opportunities that could potentially present themselves. And the second thing, as I've rightly said, is you've left money on the table, because the market, yes, has gone down, but then it goes back up. It goes back up 3 or 4 times before it actually does what you think and goes to your point. So it's the opportunity of, and people do this because they trade such small amounts of money. So people trade £1 a point here because they can make £100 by getting to here. But you can trade £10 a point, and you can make £100 if you get to here. So that's £100, £100, £100, £100, £100. By the time you've done it and missed out the bounce, we might have lost some money, you've probably made £600 or £700 in very small trades by trading 10, 15, £20 a point, rather than waiting for 7 hours to make £100 and let it go 100 pips. Now, that's something that I can't stress enough, and it's something that happens all too often with with traders, is that they're putting amounts of money into an account they can quotes afford to lose, and then they're waiting to kind of get the perfect trade, to buy the low to sell the high. All the money is made on the 15-minute and 5-minute candles. Now it looks a bit messy, but if you think about it, you sell that red line, yeah, bang, red line, bang. Red line, bang. It's not like you're making huge drops and the market's just going, but that doesn't necessarily happen on the 5-minute charts unless there's news or a big event or something serious happen. Just normal trading. This is normal trading. This is perfect. This is what you want. An in and out, and in and out, and in and out, in, out. Shake it all about. I mean, that is just how prop traders work. They're just generally in the markets, following the direction of the market, getting in, getting out, taking a bit of money off the table. Yeah, and again, you can use things like Bollinger Bands. Your Bollinger Bands are showing perfectly, where the extremes of the markets are, yeah, and where the markets will buy back. So just simple practice like that. And again, it goes back to trying to figure out, the higher world thinking. So why would I sell the euro? Well, the question for me is, why would you buy the euro? Interest rates aren't going anywhere apart from down. All the growth, all the kind of manufacturing data out of Germany is dire. You've got riots in France and unrest. You've got Europe fighting against Brexit. Remember, there's no winner in Brexit. If the UK leave the European Union without a deal, there isn't anything good happening for the EU. It isn't like they're just going to get this boost. They ain't going to get the money. They're not going to get all the kind of cooperation. There's talk about all sorts of things from the UK. It's like a divorce. Everybody knows someone that's been divorced. Yeah, you got to stay friends because of the kid and the dog. But, something fundamentally changes. You're not friends anymore. So bad things happen. So the euro, for that perspective, every time it hits that high point, you have to remember the higher kind of trajectory stuff. It's on its way to parity. It always has been. Kind of on its way down to these lower levels. There's been no savior. There's been no news coming out of the European Union that quantitative easing has worked, that interest rates are going to normalize and go back up anytime soon. So when you talk about, kind of you're getting down to parity, that's down here. Past these previous lows. There's been no significant bounce. There's been no effort by the trillions and trillions that's held, in the global markets at FX to push it back into the euro. So when I say sell it high, it's not because I have some magic crystal ball. It's every time it's got high, it's come back down. So that is why I keep saying sell the euro high. So from that perspective, when you look at the dailies, you just look at the action around key points of interest. So rejected a close above that key point of interest, it's on its way down. So yeah, absolutely, you might be at the lowest point where the market is now. So I'm not necessarily saying buy it because there's an inevitable dip or profit taking. What I'm saying is maybe you've missed the opportunities to sell. So what do? We go and look for another market. So go back to the main view and say, right, I think the euro's done. So I don't want to buy it because I've made money selling it and that's worked for me. So what else do I do? Do I get long the dollar? Well, essentially it's the same trade, isn't it? Because if you're expecting the euro to go up, then the dollar actually should start to come down from that point. So again, something else to think about. I guess the point about trading the right kind of market at the right time came back to watching the markets yesterday when there's a big move in stocks and gold. So I mean, it's essentially what you see is instances like this happening in the European session. Sorry, the Asian session. So everybody else in the world's asleep, but you see these market moves happen out of nowhere. And this was basically just that deputy level talks between America and China weren't getting anywhere. So absolutely nothing coming, and then bang, gold's on its way up for absolutely no reason. Stocks got hit hard, and then after that, it came out and said, yeah, there are some still talks happening at higher level though. Bang, gold comes all the way down. So it's not to say that you can't profit from these things. When the markets are out there, you can still put orders in the market. You can still look for movement at at tops. At the end of the day, if you're in the Asian or you're asleep and the Asian markets are happening, you could say, well, you know what, that's a pretty good level. If gold just popped above that in the Asian level, it might be a good idea to sell. Yeah, and then you put a stop, above these highs here. It works out actually very well. What you're doing is you're risking, kind of 50 pips and you could put your stop around some value, you're making 100 pips. So again, it's something else to think about. By putting orders into the market, around strategic levels, you can still profit when the markets are just doing the thing, and you're not involved in the markets. But again, you can't just do it willy-nilly. You have to put profit target. You take profit in. You got to put your stop loss in. You got to think about these things, not overcommit to too many products. And again, bias it on the side you think that the opposite will happen. So if you think, obviously gold's above 1500 now, which I think is high compared to where stocks are, that I'd be looking to sell the market, not buy. So again, you've got to position yourself for what you think might happen. Again, you can even look at doing simple algorithms. Algorithms that look for certain, types of movement or certain, speeds of volume of things happening in the market. If something happens very quickly, and it happens in a number of markets, then some news has come out, something new has hit the market, and something new has triggered interest in buying or selling a product. Okay, so what you think is, if this market has gone up for a news reason, by the time the European market's open, will that reason still be valid? And no, it wasn't. If anything, it was like a pump and dump. Now, a lot of people are cynical, myself included. Is this just news being leaked by the White House for Donald and his mates just to get involved? I've got an idea. Let's say something really negative. So I'll send the gold up, 150 pips, send the stocks down 200 pips, then we'll just buy it all back and make money for absolutely nothing because it's just a very negatively worded statement based upon absolutely nothing. And the timing of these things is absolutely magic, isn't it? The Asian sessions where volume is low and you can just bang, send gold up and then sell it back down in 3 hours, let it consolidate. When the market picks up and realize nothing's happened, the rest of the European traders come in, you're short from the top, happy days. You get your money back much lower in the range and you've made some money. So as I say, that correlated with, quite a steep drop in the stocks. But as I say, the steep drop in the stocks hit a key trend line. I was just sat here thinking, well, this is just a reason to buy as much as you want. And then again, market goes up. But if you'd have held it, bang, comes all the way down, left money on the table. So again, I was out somewhere here. As it came down, bought back here, then got out here. So nowhere near made the most of the move, but doesn't matter. I was back involved here when the market's open, got out here. That was quite a good trade for me, for what I wanted. So 3 opportunities, for the market to go up, and I've made more money because I trade bigger size and taking money off the table than would have been buying here and holding for the best part of a day and a half to here. So again, it's all about understanding that trading is about, compounding that money, that initial investment you've made, the capital that you work with. You put money into the markets, you risk, and then the less amount of time you're in the market, the less physical risk you can take. Because actually, when you're long here, you're taking all the risk that you can make money and go back. But you're taking all the risk, they can go all the way down here and break these lows. Yeah, there's nothing to say the stock markets aren't ready to finally correct significantly. And if you haven't got your stops in play, you could wake up in the morning and you could be anywhere, anywhere towards these points of interest. You could be 2, 3, 4, 500 pips offside without even knowing, and that has happened. More than once. I've advised people and worked with people that that don't use stops, and they've woke up and they're because you're never on the right side of it. You never just hear the stories that you were 100 pounds a point long the stocks and they went up, gapped up 500 points overnight. Of course, it does happen, but the majority of times you do that, just by, kind of trader's luck, you end up being on the wrong side. So again, it's just another simple trend line. The 423 spot 6, down here, a full retracement of that Fibonacci, example, and then you just make all the way back to that 50%. So, again, that every time I've shown you a higher time frame chart of the S&P, rejection higher, rejection higher, rejection higher, gap didn't close, rejection higher, rejection higher, rejection higher. So when the market comes down on no news and it shoots back down, what do you think is going to happen on the more tradable short-term time frames? Bang, the market hits a point of support, doesn't close below and goes back up. So even looking at the 15-minute chart, again, all you're looking for is the low point, and you can buy, buy, and they just buy and just keep buying. And if it goes down, you get out. You don't hold it all the way down and average in anymore because the moves are too violent. They do come back, but you take too much risk on. So, you know, if the market's doing this and it gets to this point, you just get out. And you think, well, where could it go to? Here, so you buy it here. No, it's gone down. Get out. But then you start to buy it. Yeah, you make your money back. Make your money back. All your money back. Yeah, now you're in profit. Low again. Buy it. Profit, profit, profit. Low, not too much to do here. Again, profit, profit, profit. Low, profit. There's much more opportunity to go with your overall view. As I've said, buy the dips in the stock, sell the euro high, buy the pound low. Yeah, and once you get into that mentality, you're not getting top and tailed. Although I keep saying, you know, be market neutral, be ready to buy and sell. You know, that's for something for you to work out. I can't give you all the answers. After, you know, 20 years of trading, I just do what I do. I look at this screen, all I'm looking to do is for it to be high so I can sell it. Look at this screen, all I'm looking to do for it to be low, so I want to buy it. Get it? All I want to do is this to be low, I want to buy the dollar. And then stocks, the same. Every low point I can see, or any point of interest, any trend line, any Bollinger Band, any fib line, I'm looking to buy low and then just get in. And again, it's 10, 15, 20 pips. Yeah, I can tell you every single market here if they're going to go up or down. But I've learned bitterly from bitter experience, there's no money to be made, for me, the way I trade, in being right. The way I've made money is by being right at the right time, taking little bits of the bigger trend, yeah, continually banking money and getting out when I'm wrong. And in these markets that move so viciously and are so aggressive in their kind of moves up and down, you know, it doesn't pay to be a hero. It doesn't pay to be, you know, a big negative averager anymore. Back, you know, maybe a year ago, 18 months, it did. So you have a lot of big moves that quickly retraced and you could take a lot of pain on. But how the market's moving right now, you have to adapt your style. If you try and take the markets on, it's more than likely that you're going to get hit. And, you know, you get hit with your capital reduction, you get hit with your confidence, and you get hit with just not picking the right style to trade, you know, in the current conditions. So that, again, is something else that ties in with this idea of trading different products, is that every product has its own personality. So the DAX won't necessarily move the same as a euro dollar. You know, all these things are linked and correlated in some way. But again, those correlations and sentiments change. Now, as I say, you know, another interesting one, if you're just looking at the kind of FX markets, you know, is to trade things like, you know, the New Zealand dollar and, you know, the pound against the New Zealand dollar. Now, there's reasons for that. Again, when you think about how the Americas dealt with the global financial crisis, you know, quantitative easing, ultra low interest rates kept them very low, how Europe dealt with it in a very similar matter. In places like New Zealand and Australia, that didn't happen quite the same. You know, they spent money in infrastructure, you know, they brought rates down a little bit, but nothing like, you know, the rest of the world did. And they didn't pump all this money in to, you know, to kind of prop up the market to keep the banks going. So that means that 10 years later, these places aren't fixed. They're just further down that kind of economic cycle. So when things do happen, what they're going to do? They're going to cut interest rates. So as I said, when, you know, I live in New Zealand, so, you know, I have a little bit more inside knowledge, but it does take you a while to get into the psyche. So as I was saying, you know, this line here, that's what it looks like when things are high before they go low. And as you said, you know, all came out and cut the interest rates by 50 basis points. And essentially, it's a race to zero now between Australia and New Zealand. So all the market's doing is coming down. So yes, it has a little rally towards the bottom, but it's still consolidating. It's still going to continue towards these lower points because it's still at 0.75. So by May of next year, it'll be at 0.25. So there's still half a basis point to go. Now, you know, the pound, on the other hand, you know, the pound was historically, you know, doing pretty well against the New Zealand dollar, you know, back in the day. But then Brexit happened, yeah, and we saw all this kind of selling action, but the market kind of recovered, and now it's consolidating. Well, the thing is, you know, if New Zealand's in trouble, it's, you know, its kind of economic data is dire. You know, business confidence is non-existent, and it's 4.8 million people. So 4.8 million people versus London. Come on. I don't think so. So yeah, we might have Brexit, you know, weighing things down, but that's again was pushing it down here. But when the reality comes through that, yeah, okay, London might be a hit after a no-deal Brexit, but it's still going to be 100 times more valuable than New Zealand is. So that's what the low of the dollar, the pound against the New Zealand dollar looks like. Big rejection there, you know, a nice hammer formation, shooting star, and then bang, the markets go back up. So kind of intraday, all you're looking for is low points to buy, low points to buy, low points Well, that's a lucky trade based upon, you kind of Brexit, kind of positivity. But yeah, you let it go up, you buy it, then you get out, then you buy it when it's going back up. You've got points of interest all the way to aim for, and you just keep riding the wave and buying more. And I said, like, you could do that. This kind of hourly candle here. You could buy into that 4 or 5 times, as it comes down. Yeah, rejection. You're buying it as it's low in the range. As you see, you'll just see that being a big red candle, and then being a big green 15-minute candle. That turns into this hourly candle with the tail and rejection. Then solid candle, same scenario. Yep, so the market keeps pushing up. So, I mean, this is the kind of things, you've got to look out for. Not saying that, you have to understand the economy of New Zealand and Australia inside and out, but if countries that didn't move their interest rates aggressively when things were looking a bit wobbly, then when things get a bit wobbly, what are they going to do? So it's almost like looking at a kind of a fresh, brand new market and fresh, brand new currency, and saying, well, what happened in the markets we do know? So what happened in the euro when quantitative easing happened? What happened, with the pound when we started bond buyback programs? And then what will happen to the New Zealand dollar against the US dollar when these things potentially may happen? What will happen against the pound? Well, the pound's been sold off tremendously against Brexit. We'll get into D-Day with Brexit when we actually know what will happen. Now, for me, any news is better than no news for Brexit, so it's all a positive. So they can see when the market got low down here, your big-term speculators, your long-term investors, your central banks, your hedge funds, your governments are thinking, well, I'd rather have pounds over New Zealand dollar any day. So, yeah, we can have these big spikes and big sell-offs, but at the end of the day, it's still looking very unlikely to come back to these levels anytime soon. But as I say, they were kind of projected. They were projected with forward guidance. They were projected with low levels. And again, it's all very easy to say this in hindsight. And yeah, I'm sat on an absolute ton of pounds against the New Zealand dollar down here. But that's one of the very few trades I've ever done that's been long term. That's just because, again, different circumstances. I live here. I earn a lot of pounds. So why would I not have pounds over New Zealand dollar? It's a double win for me. So again, I don't want to say that I can't also intraday trade at the low points and get back in, but I'm tending to not to, because I've got a big long-term trade that I think is going to get to here. So I'll get it out there, and then I'm happy. That's good. In the meantime, there's lots of opportunities in other currencies, as I say, selling the New Zealand dollar high, against the US dollar, which is far superior. And I'm not saying it's a better country run by better people or anything like that. Certainly not. If I thought so, I'll go live in America. What I'm saying is it's a superior currency in the economic climate right now. So again, when you're talking about risk on and risk off, I would always put my money in dollars over New Zealand dollars. So again, it's how sentiments change, because things like the New Zealand dollar was a safe haven because, again, even just a year back, GDP was pretty good, high employment, government's not got a massive deficit, run by Jacinda Ardern, what a great lady she is, etc., etc. Yeah, we'll stick our money there because that's the end of the world. Nothing bad's going to happen. But bad things do happen. Bad things happen everywhere. And it's not just about bad things to do with terrorism. It's bad things to do with poor business management. Frontera, the biggest industry, lost 680 million. Don't know how. Just some bad acquisitions, apparently. Biggest industry. What's the next biggest industry in New Zealand? Yeah, logs and tourism. Oh, good luck with that. That's going to plug a hole, isn't it? So again, it's all about thinking about what's driving these countries, what's driving the GDP figures, and what's not driving them. Because if they're not being driven, then they have to be created, and that comes from cutting interest rates, because we've seen that work globally, work globally, and then we've seen what the reaction has been to the stocks, to asset prices, and to currencies. So again, just another very kind of simplistic way of looking at the FX markets, just by looking at interest rates and correlations between GDPs and strength of economies across the board of different countries. So, I mean, all these things I take for granted, just because I've done them for so long. And, people don't teach you this stuff. And you think they should do, but they don't. You have to build a picture of the world in your own way. And that's how I did it. I built a picture of the world through these 8 screens. And, by looking at very simple news sources like Twitter feeds, FX Street, Bloomberg, I can get the news quick enough when I see things move. And it might not be the market that moves where the opportunity is. As I said, if you see things like the pound ramping up, It might, if you've missed that move in the pound, it might be an option to get involved high in the FTSE and sell the FTSE because, as the pound becomes more expensive, people get out of, kind of more expensive opportunities like, buying expensive FTSE. Yeah, and maybe, that again, when you see that's the great correlation, as the DAX is going up, because the euro is going down. So that's like a double whammy for the FTSE because, again, DAX is going up, that can't follow, pound's going up, so more people then sell the FTSE, and then as the euro is going down, the pound's going up, they put it back into the DAX. That's how quick and efficient the markets work. The understanding that everything is traded in baskets, everything is traded in cooperation, and everything's traded within, kind of specific limits of where, things can be made. And as I said, it's not about making, 100 pips. You can have these algorithms that are running there just trying to make 10 pips, but they get enough size and volume through the market. There's tens of thousands, hundreds of thousands, millions of pounds to be made just by getting into the markets quick enough and being right at the right time. So everything on this screen here can be a trigger for all the other products. Now, I was very mindful that last time I did the webinar, I just again got into Steve Ruffley presenter mode and kind of just talk. So, are there any kind of questions, any thoughts? I mean, this whole idea today is about why you should trade products that are moving based upon the correlations and based upon what's happening in the world. So, GDP expectations, rate expectations, and again, just looking for things that are susceptible to news. So, things like Donald Trump's tweets. And we saw that, as I said, as the example I showed in both stocks and gold, about the trade wars not happening, then the trade wars were happening. So big moves that happen, and it's like the market did nothing. But if you woke up in the morning, you just thought, oh right, well it went up and it went down, so it's actually done nothing. But you've missed an opportunity because you weren't there to see that actual movement. So you mentioned you added the Nasdaq to the market recently. I started looking at the Dow recently. What would be interesting in your view of that market? All right, good question, Gary. I mean, the thing for me is that, yeah, I mean, the Dow is the biggest market in the world, but I've always historically stayed away from the Dow and been much more interested in the S&P, just because I think it's a broader measure of what the US is all about. Now, the reason I want to put the tech over the Swiss stock market is that, you got to remember that, a lot of the unicorns, a lot of the kind of, money and interest that's generated, is from tech, and it's from your Facebooks and your potential floats of Airbnb and your WeWork fiascos and that kind of stuff. So generally, why I keep the tech there is that seems to be the market that moves the quickest. Now, you have to realize that why does the tech move the quickest? Well, it goes back to this whole idea of who moves the markets. Well, it's the 1%. Well, who's got all the money? Yeah, Mark Zuckerberg, Bill Gates, Jeff Bezos. They're pretty into tech, aren't they? Now, I've worked a lot with family offices. People that have more money than God. Yeah, all these people have family offices, so they know that if they want to protect their wealth and the stock market's going to crash, they can also sell in the short term to hedge off what they've got, their own stock. So they can't really lose. They have the money and the size to do these things. So when you see the stocks, the tech markets move, that's an indication to me of what the richest people in the world are doing, because that's what they own. They own tech stocks. So that again is meant to be a trigger of potentially what could happen in gold. Yeah, because again, risk off, the markets go up, gold should come down, risk on. Stocks go down, gold goes up, and it could be a trigger to the DAX. If the DAX is low, eventually it will follow the S&P. And the S&P, generally, for me, it's being triggered by big moves in the tech. I mean, look at the chart; it looks pretty much exactly the same. But I think you see maybe only a few seconds. You might only get a few seconds warning in the tech over the S&P. But for me, a few seconds is all it takes. If you're ready and you understand how the markets work, those few seconds could be the difference between making money or not. So that's why I have that over the Dow. How do you get the green and red lines? Well, the green and red lines just come from my fib indicators. So iView charts that I've talked about for years and years now, they're automatically drawn on. So I'll go through a fib demonstration in a minute because just be handy to do that. Costs would increase with getting in and out. Yes, Morenza. Got to break some eggs to make an omelette, love. At the end of the day, yeah, costs go up. Costs are a part of trading. But at the end of the day, if you're making money, what does it matter? The idea is that if you just do £1 a point and it only costs you 20 cents, to put that pound on, or a pound to put that pound on, it goes 100 pips, you make £100. Yeah, you still only made £100. That's not going to get you anywhere. If you're trading 20, £30 a point, and it costs you £30, but you're making £200-300, you're making £200-300. So you can see my point with that. This isn't a game where you get penalised for costs. The cost is just the spread. You're trying to make money from trading. So if you're not trying to make money from trading and you're worried about the cost, you're in the wrong industry, absolutely, completely. So, let's just take Euro Swiss. Never traded it, really. So, you're looking at the hourly chart. So, yeah, not a great deal of interest happening. The Euro's going up against the Swiss, so a bit of risk on. Look at your kind of monthly chart. No, it's not working, is it? Let's try dollar CAD. I don't know what's happening here. Right, that's better. So yeah, the reason why the fibs are automatically drawn and everything's automatically drawn is because what you don't want to do is this. So if you want to do something, like figure out where support and resistance is, on the higher time frames, this is what you do. You go through, you draw your higher time frame points, yeah, and then you go, right, where's the next one? Weekly. Oh, okay. Well, there'll be some weekly ones here. Let's even be a bit more kind of professional. So again, just line of sight. This is what we used to do in the olden days. Well, these are your kind of weekly points of interest. Then you've got daily. So again, what your daily points of interest. Don't do you any when it fucks around like this. So a blue line. So when you come to your hourly chart, then all of a sudden, you've got your higher time frame points of interest. You've got your daily and your weekly and your points. So then, what you'd have to do is your Fibonacci. So your Fibonacci is going to be the last significant move. I think the market's going up, so it's that. So you draw the Fibonacci of the high to the low, and you got your 50%. Mark that in. So that's your pivot point. So your pivot point here is this level here, 1.33053. And then your next point of attraction, obviously, is a break 61.8. Then the 100%, which is a level of support, resistance interest. Then your fibs here that start to match up, and that's it. That's how you would do your higher time frame trading. Support and resistance, technical analysis. Then how you'd integrate a kind of a short-term kind of pivot from your Fibonacci. So yeah, it's not massively labor intensive, but it wasn't, it was line of sight. It was a bit rough and ready type thing, but you could do that for every product if you wanted. Or what I do is I just do this, and then I've got everything I want. I've got the higher time frame points of attraction. I've got active pivot points on the open candle, and I've got my overall Fibonacci, of where the market's going to get to, and that. So that's just it. That's 20 years of charting. That's 20 years of going through webinars, thousands of webinars, just by clicking one button. And that works on any single product. All you do is click that button and you get your technical analysis. So that's the whole point about being ready for the markets. So the reason why I can trade and only trade like, maybe an hour a day and make the money I do is because everything's already set up. I'm not second guessing where the markets might go. I'm not trying to figure out, where's a good value to buy. The value's always on my screen. At any one point, value is screaming out to me. Value, buy me, sell me. And as I say, I do position myself in certain ways, only buy and sell certain products. But that again is just my own personal preference. What you're trying to do as a trader is take all that complexity of trying to be an expert in fib, an expert in Elliott wave, an expert in pivot points, and again, not worrying about that too much. You need to worry about getting your size up. Being comfortable trading, at least £10 a point. If you're not trading £10 a point, you will never make any money trading. I absolutely guarantee that. And this is the biggest problem I have. It's psychological. It's getting people not to put money in an account they can afford to lose, because everyone can do that. You're setting yourself up to lose before you even win. The number of times I've had people that put £5 in an account because they can afford to lose £5, but then lose it 5 times. Well, I said, why don't you put 25 grand in an account? Because then it's a different mindset. That's money you don't want to lose, rather than money you can afford to lose. This is the battle I've always had, because you have to read those statements. 78% of retail investors lose money. Yeah, because they put 50 quid or they put £500 or even £5 into an account and they lose it, because that's what the markets are designed to do, to take your money. The amount of people I've worked with that have 25 grand in the account and lose all the money, that's the 22% of people that don't. Yeah, the people that put 50 grand in, 100 grand in, they're the people that, yes, they have losing days and weeks, but overall they win because they have the amount of money to take through the bad days. Yeah, you can lose £500 in these markets on 10, 15, £20 a point, yeah, in 15 minutes, and then you're just another statistic. So I'm not like I'm sit here and like, spreading out these crazy rumors that, everybody in the markets, makes money, and everyone who kind of does my mentoring makes money. It isn't. They're all just statistics. You can prove anything with statistics. The more money you have in your account, the better chance you have of not being that losing statistic. Yeah, it's just like a business, exactly like a business. Yeah, if you start undercapitalized and you can't continue, it might be a good business idea. You might be a good director. You might be good at what you do. But if you run out of money, it's game over. You run out of money. And this is the main problem, and my big kind of problem with the European Union coming in, and ESMA being brought in to limit that leverage. It's just hurting people that are just a statistic. Yeah, just because somebody's put a few £100 in a spread betting account and thought, I'll give this a go. I'll trade some gold, and they've lost all their money. It's only 200 quid. Right? You don't go through the bookies, do you? And go like, everyone who's lost 50 quid in a horse bet, well, we should just stop horse racing betting now. Everything should be limited to a £5 bet. No, because that's just seen as frivolous gambling. It's only 50 quid. Well, if you only put 200 quid or 500 quid into your account, it's nothing in the markets, I'm afraid. Yeah, there's $1 trillion traded in FX markets every single day. So you want to be part of $1 trillion market, you have to scale up a little bit, guys. You can't just put a tiny amount of money into an account because you have absolutely no chance of winning against the markets. So this is what I've always said. People have always said, how much money should I put in, Steve? How much money does it take to be a trader? It hasn't really changed. 25 grand for me is the benchmark of where you should be. 25 grand you can trade for a living and make enough each month, yeah, to both take a reasonable loss and make a reasonable profit. Now, people don't want to hear that, because 25 grand suddenly becomes a real amount of money. That's a car. If you make, that's a watch. It means things, but it is what it is. I have never lied to you in these webinars. I've never told you that it's a way to get rich quick. It's a way to leverage your time and money to make money if you have the available capital. Now, that's got harder with ESMA, as I know, because you have to put more money in, but there are options. Moving people into different kind of areas where you can use brokers with more leverage. So all you have to do is come to me and speak to me. And these are what these webinars are for. I tailor your trading needs around what's available. I know more people than you. I've just done more than you in trading. Doesn't matter who you are. There's nobody. I don't think there's anybody. And I can say this, there's probably 15, 20 people in the entire world that have done the range of jobs in finance that I have. I just have, because nobody would just do the things that I've done. They just wouldn't. I've done from writing algorithms to trading hedge funds to managing the biggest trading floor in Europe to risk managing some of the biggest traders there are, from writing books to mentoring individuals, to being a prop trader, to backing traders. I mean, there's literally, you know what I mean? It's kind of, there's very little in this kind of trading sphere and community that I haven't done. And it's not just the little bits. I've done lots of it. I've done over 1,000 webinars for Intraday. You know, I've done over 100 webinars for FX Street. You know, for before I stopped doing non-farm payrolls, I've done consecutive non-farm payrolls for 8 years. You know, I've been out there putting out my message, putting out my what I've learned. And the thing is, you know, it's all free. So like you get all these kind of idiots on Facebook saying those that can do, those that can't teach, right? I won't be sat here doing this for nothing if I haven't already made a ton of money today. Yeah, because I don't even get paid to do these intraday webinars anymore, right? They're moving in a different direction, but I still continue to do them because it's like a habit. It reinforces what I know. If I get some people trading, good. And you have to remember how I make my money and all this stuff is I turn people, proper people, into funds. Yeah, and I back them, or you know, we do things in concurrency. That's how I make my money out of all this stuff. This is just a big shouting platform for me to find people that have some money, have some ambition, and can do trading properly. And I turn them into funds, so I make huge amounts of money from that. From the rest of it, I don't make any money whatsoever, none. And that's what I'm going to do from now on. You know, if you want a bit of my time, it's free. You want my charts? They're free. You can have a little bit of my IP and time for free if you show you're willing. So that means don't come to me with a sob story that, you know, oh, I've lost 3 accounts, blah, blah, blah. Come to me with some positivity. Yeah, Steve, I'm willing to, you know, learn and be moved in the right direction. I have 15, 20, 25 grand, or I have 100 grand. I want to go and make some money out of this. Let's do it. Yeah. And the ultimate aim of all this stuff is to turn you into a fund. I, you know, put money in or I raise capital for you, and all of a sudden you become your own fund manager. Now, that's an interesting job, isn't it? You're not just a trader anymore, you're your own fund manager. So that's the secret behind all this side of my business. SteveRuffley.com, I turn people into funds. That's what it's all for. Yeah. And I have to kind of appeal to everybody because I never know who's going to make it. I never know who's going to have the ambition. And it's not always the people that have the most money that become these people. It's people that can get the consistency and can deal with scaling up their trading and trading the bigger size. Because bigger size, you need to trade bigger size with bigger amounts of money. Bigger amounts of money, that's right, boys and girls, you make more money. And that's how this entire industry is built. So that is the secret of how I make my money. I turn people into funds. The rest of it is just all from my own trading activity. So when you see the houses I'm building, see the cars in my garage, all that kind of stuff, that didn't come, you know, from doing a webinar every week. You know, that isn't the way it is. I used to get a small retainer from Intraday to be their face, but that doesn't exist anymore. So again, I just do these webinars now for the pure reason that I want to meet some people that want to make some money trading. And that's what I've done. I've turned people with reasonable amounts of capital into funds, and that's where I, you know, eventually make some money out of this. So there we go. Really, when you're talking about the markets and what to trade, it's all keeping your eye out for changes in the market sentiment. So what the market knows, the efficient market hypothesis, is sending gold down, sending stocks up. That generally is to do with trade war and, you know, China at maybe, you know, some positivity. They're going to do a deal. They're going to tie up with the currency. Donald Trump's a genius. Everything's going to be great. But that sentiment could change very quickly. So, as I said, you know, if the trade talks look bad, then the stocks are going to come down hard and gold's going to go back up. Yeah. Same with interest rates. You know, again, look at, the correlation of the pound spiking up on positive Brexit. But, you know, again, if there's with a negative Brexit and no deal, then there might be, you know, an interest rate cut to try and stimulate the economy. Then all these moves will retrace, you know, very quickly and then over retrace very hard because the sentiment goes from positivity, you know, Brexit's going to happen. Well, we might not have to cut rates any lower. So suddenly, yeah, Brexit's going to happen. Trillions in debt. World, everyone's going to die. No food. Blah! It'd have to go down, and then, you know, a big correction after that because the sentiment has been reversed. So as I say, keep those 8 products open. If you get iView charts from me, as I said, I'm going to give it away free from now on. I'm still updating the website, etc. But you know how to get a hold of me. Steve@steveruffley.com, on Skype. Steve Ruffley, Twitter @Steve Ruffley. Just Google Steve Ruffley, you can find me. And I want to work with some people, you know, to kind of help them become, you know, just consistent traders to start with. It's a long process to become a fund. You know, it's a long process to get the confidence in yourself and to get all the kind of, necessary things together. But that's, again, where I'm aiming at. So, again, all these webinars are going to be more based around live markets, how you actually make money, how you set your charts up. And again, this is just another indication of what you should be looking at. You should be looking at these 8 charts every day and then just going down and thinking, yeah, DAX, that's what I want to trade today. That's the opportunity. Yeah, Steve said, buy the dip because that's where you're going to find some potential value. So bang, 5-minute candle, bang to the 161, buy it here, bang, made some money. Or let it retrace to here, yeah, bang, you still made some money. Your lines, your points of interest are still there, and you can still buy low and get out high. All right, guys. Well, that's pretty much it. I would say that's another good session. A lot to take in, a lot to kind of take responsibility for. A lot of people don't want to put this time and effort into having these setups and having the technical analysis ready for them so they can trade at a minute's notice. And, that's really crucial. And, a lot of people just skim through the news, but, skim through it in different ways, break things down into areas, break the US down into the US, look at the dollar, break Europe down into Europe and the euro. It sounds obvious, but people don't do it. Look for the opportunities, because not everybody's on the same economic path and economic cycle. So the FX markets are perfectly designed to talk about, changes in GDP expectations and rate expectations. Yeah, that's absolutely what the FX markets are designed to do. And they're not just being traded by people anymore. They're being traded by grey boxes, black boxes, algos, news scanners. Yeah, so the markets are now moving 24/7 based upon anything. So you have to get into that mindset. If you want to make money 24/7, you can speak to me. If you've got some ideas, I can put you in touch with my developers. I can create, some simple algorithms. I've got algos running through the markets that have taken probably 2 years and tens of thousands of pounds to to get to fruition. But that just means they're ticking away in the market, trading when I can't be at the screens. And as I say, I don't trade that much anymore because I don't have to. So I might trade an hour, 2 hours a day, max, absolute max. I haven't worked more than 15 hours a week for a decade. And why should I? What's the point? Yeah, life's for living. Become like me, become a time billionaire rather than having billions and millions in the bank. What a lot of nonsense that is. I've got enough money to do whatever I want whenever I want. I get to see my daughter grow up, and I do exactly what I want to do whenever I want to do. That's the definition of being rich. Let you own the money, not the money own you. All right, guys. Well, anything else, get me privately. I'm going to be around on the screens for the next hour. So get me on Skype, Steve Ruffley. Don't waste my time. I'm not interested in time wasters. You've got no money and you've got all the ambition. Go and find the money from somewhere. Yeah, because this is real stuff now. If you want to make some money, have some of my IP and time, then I can only do that with people that have the opportunity, and that comes with having access to some capital. All right, guys. Well, good. Hope you enjoyed that. We're going to be back the same time next week. Sign up to my YouTube channel. I've just redone that. There's over 1 million views from interviews and various things I've done over the years. I'm still in the process of tidying it up, but they'll give you a good bit of offline chance to get to know my style and what I'm all about. And again, be ready when you talk to me because I don't suffer fools. If you want to do something, we'll do it, and I'll help you to the end of the earth. But if you want to give me some sob story, I ain't interested. All right, guys. Well, listen, enjoy the rest of your night. I'm going to be here for the next hour or so, and I hope you enjoyed it. And I'll speak to you all very soon. Cheers, guys. Bye.